And so I want to share the story of Brian Nabavi, the CEO of a e-commerce company called Till You Collapse. He came to us. He was starting to scale, starting to get to the point where he could take a regular paycheck out of the business and getting close to 7 figures in revenue. And he was still doing his own tax return because he wanted to save money on tax prep fees. And Brian and I still laugh about this, but when he came to us, he was literally forced to because he was trying to buy a home, and the lender was like, I can't qualify you on self-prepared returns. You need to have a CPA look at this. And so we went and we prepared his returns, but while we were at it, he was only a few years in business. So we looked at his first 5 years in business, and it turns out that Brian had overpaid on average by $40,000 per year in the first 5 years he was in business by saving a few bucks on tax prep fees and tax planning. Now, I don't know about you. For those of you who are still in your first 5 years in business, or for those of you that are further along, we can still remember your first 5 years. How much would an extra $40,000 per year of cash flow help with getting that business off the ground a little faster? Just a little bit? Yeah. So Brian learned, he was thrilled to start saving money moving forward, also a little frustrated, but learned a very valuable lesson, expensive lesson that day. And that lesson is this: the best time to do tax planning is actually before you have the income, or before you start the next company, or before you sell the business. Because once you've earned the money, once you've done the thing, once you've sold and signed the dotted line,